Hello, I'm Edward Sterling, macro analyst for Bulwark Bullion. And today we're looking at a silver market that seems strangely calm on the surface. Prices have been hovering around the high $60, roughly $68 to $69 per ounce. At first glance, that doesn't look like much is happening. But under the surface, silver is being pulled apart by two very different macro forces. On one side, the long-term bull case for silver is actually getting stronger. Industrial demand continues rising. The global electrification push is accelerating, and supply growth has struggled to keep up. But on the other side of the equation, something else is happening. Bond yields are rising again. And historically, that has been one of the most powerful forces working against precious metals. So the silver market is currently caught in a kind of macro tug-of-war, a strengthening long-term bull case, and a bond market that is pushing back. If you look purely at fundamentals, silver has one of the more compelling long-term stories in commodities. Unlike gold, silver isn't just a monetary metal. It's also deeply tied to industrial demand. Roughly half of global silver demand comes from industrial uses: electronics, solar panels, electric vehicles, advanced manufacturing. And as the global economy continues pushing toward electrification and renewable energy infrastructure, demand for silver is expected to keep growing. At the same time, supply growth has struggled to keep pace. Mining output has been relatively constrained, and several analysts have pointed to persistent supply deficits in recent years. Put those factors together, and the long-term story begins to look fairly bullish. But commodities rarely trade purely on long-term fundamentals. They trade inside a macro environment. And right now, the macro environment is dominated by one market in particular: the bond market. Treasury yields have been climbing again, with the 10-year yield moving toward roughly 4.3 to 4.4%. That move matters for precious metals, because silver, like gold, is a non-yielding asset. It doesn't pay interest. It doesn't generate income. So when yields rise, the opportunity cost of holding metals increases. Investors can suddenly earn more simply by holding Treasury bonds, and that tends to pull capital away from assets like gold and silver. But the real issue isn't just nominal yields, it's real yields. Real yields measure interest rates after adjusting for inflation. And historically, precious metals tend to struggle when real yields rise. Because in that environment, investors can earn positive real returns from fixed income assets. That reduces the appeal of holding metals as a store of value. So when the bond market reprices higher, metals often feel the pressure almost immediately. There's another channel through which rising yields affect silver: the US dollar. Higher yields tend to attract global capital into dollar-denominated assets like Treasury bonds. That pushes the dollar higher. And because commodities are priced globally in dollars, a stronger currency often creates additional pressure on metals. A stronger dollar makes silver more expensive for buyers using other currencies. That can dampen international demand. So when yields rise, silver often faces pressure from two directions at once: higher opportunity costs and a stronger dollar. That combination has historically been difficult for precious metals to overcome. Before we go further, if you're enjoying this breakdown of silver and the macro forces driving global markets, make sure to hit the like button and subscribe to the channel. We publish regular analysis on gold, silver, and the broader macro trends shaping the financial system. One of the reasons silver can be particularly volatile in environments like this is its dual identity. Silver is both a monetary metal and an industrial commodity. Gold is mostly driven by monetary forces, interest rates, inflation expectations, and currency movements, Silver reacts to those forces too, but it also reacts to the global economy. If investors start worrying about slower manufacturing growth, weaker electronics demand, or slowing industrial activity, that can weigh on silver, even if inflation concerns remain elevated. That's part of what makes silver markets so interesting. The metal often sits right at the intersection of macroeconomics and industrial demand. And when those forces start pulling in different directions, price action can look surprisingly flat, even though the underlying macro story is anything but quiet. One of the reasons silver can be particularly volatile in environments like this is its dual identity. Silver is both a monetary metal and an industrial commodity. Gold is mostly driven by monetary forces, interest rates, inflation expectations, and currency movements. Silver reacts to those forces too, but it also reacts to the global economy. If investors start worrying about slower manufacturing growth, weaker electronics demand, or slowing industrial activity, that can weigh on silver, even if inflation concerns remain elevated. That's part of what makes silver markets so interesting. The metal often sits right at the intersection of macroeconomics and industrial demand, and when those forces start pulling in different directions, price action can look surprisingly flat, even though the underlying macro story is anything but quiet. Silver's long-term bull case hasn't disappeared. If anything, the structural demand story is arguably stronger than it has been in years. But markets don't trade long-term stories every day. Sometimes they trade the bond market. And right now, the bond market is clearly the dominant force, which means the next major move in silver may depend less on industrial demand and more on what happens with interest rates. The real question now is simple. If yields keep rising, can silver's growing industrial demand overcome the pressure from the bond market? Or will the macro environment keep the metal capped for now? Thanks for watching. If you're interested in gold, silver, and the macro forces driving global markets, make sure to like the video and subscribe. For more analysis, visit bulwarkbullion.com. I'm Edward Sterling, macro analyst for Bulwark Bullion. See you in the next one.